Certainly one vital part of the domestic economy that's sending out mixed messages is retailing. There's plenty of evidence to suggest that times are really tough, yet figures out this week show the pickup in consumer spending is continuing apace. So what's happening out in the big shopping centres? I spoke to one of the biggest landlords, GPT's Michael Cameron. Well, Michael Cameron, you've just come back from an investor roadshow in Europe, and you must have been pretty well received because the GPT shares have been doing well in the last 12 months. But they're still selling at a big discount to NTA, net tangible assets. Are you telling investors that you can get the share price up to NTA and perhaps even beyond?
Yeah, the sector's seen a continued discount from NTA, and one of our major focuses has been to try to close that gap. One of the things we've done is to drive earnings up, and that's definitely helped, and we seem to be trading at a far less discount to the rest of the sector, but it is still something that we see across the real estate industry in Australia, which is in many ways an opportunity, because I think as trust and confidence builds in the sector, we'll naturally see that gap close. The other interesting thing, of course, is I suspect there's some tailwinds on valuations, so we may in fact see NTAs continue to rise. So hopefully we'll be in a situation where we're chasing a moving target.
I'm surprised to hear you say valuations are rising. I mean, everywhere you go, people say that retail is in trouble, manufacturing is in trouble, finance is in trouble. So I can't see how valuations are rising.
Well, I think it's fair to say that the news on retail is that it's pretty tough out there, but you need to be careful to not to generalise. And what we're seeing within our portfolio, particularly in GPT's portfolio, where we only invest in large regional malls, is that there is sales growth, but I think in some of the smaller centres and the sub-regionals, there's definitely a lot of stress and quite a significant downturn. We've seen this year about a 2 to 3% increase in sales, and that's been reasonably healthy in a fairly subdued environment. In the office market, though, we are seeing a bit of pressure on rents to increase, and there really is a shortage of space. And interestingly, given the strong Australian economy, the demand for space is still quite strong at the top end. Again, it's very difficult when you generalise.
Just back to retail for a moment. You've always enjoyed occupancy rates in your malls of close to 100%, 99% or so. Are you seeing any pressure on that? Any empty stores in your malls at the moment?
We do see some groups moving out. We saw the Red Group move out. Colorado also go through their problems. But we were able to fill that space pretty well straight away, and in most cases at a high level of rent. So, no, we don't see any direct pressure at the moment, and the full occupancy, or 99.9% occupancy, is a feature that we see again across the higher quality malls.
It doesn't seem to be the case with strip shopping centres. I'm seeing a lot of empty stores in those.
Yeah, absolutely right. I think in the suburbs, in strip shops where there's lots of mums and dads, they don't benefit from sort of a national chain where you can get purchasing power and also benefits from the strong Australian dollar. And there's definitely a lot of stress at that level. And that's just the difference between, I think, investing in high-quality, large malls as opposed to the smaller retailers.
Do you think that trend is going to continue, that the strip shopping centres will be hollowed out and the activity will move to the big malls?
Well, whilst we see a level of sentiment and a lack of confidence by consumers, and I think every day people wake up, they see sensational news about Europe and the US, and there's always concerns about what's happening in Australia as far as changes to tax legislation and those sorts of things. There'll still be an increased level of saving. There's nothing wrong with levels of income. I think income generally has been rising, but people are definitely still saving at a rapid rate. And while that's happening, then some of the smaller centres are going to continue to do pretty tough.
Obviously, the retail investment trust sector suffered huge credibility problems during the credit crisis. How far back do you think it's still got to go?
It's an issue of trust and confidence, and I think some parts of the sector have done a good job. Overall, most of the larger trusts have, of course, recapitalised, reduced debt, sold out of troubled assets, and GBT's been a great example of that, where we've brought the business back to being 100% Australia. It's very lowly geared now at 21%. And we're essentially have the same structure now as we did many, many years ago. So we're definitely over the troubled times within the sector, but it's really that trust and confidence that takes a long time to come back. So I think that's being restored every day as, within the sector people make good decisions and run the businesses very well, but it will take some more time.
You mentioned there's demand for office space. Where's that coming from?
One thing that happened during the credit crisis or the global financial crisis was people stopped building, and the world kept going on, and particularly in Sydney and Melbourne we see the banks, the audit firms, of accounting firms and even the legal firms continuing to expand, which is probably different to what you would expect, but we see increased levels of requirements. We also see people moving up from B-grade space into the premium space, and of course the GPT portfolio is one of the best quality in Australia, so we're really the beneficiaries of some of those trends. But there is lots of demand out there, and as I said, that's going to put pressure on rents, and we'll see that reflected in valuations over time.
You've got a development pipeline of $3.3 billion. How much of that's going to go into retail and how much into industrial and offices? Well,
we have a diversified portfolio, and I think in a period where there is concerns, particularly around growth, the three areas that we're in, retail, office and industrial, have very different characteristics. So there's great benefits in being diversified. For the pipeline, as we go forward, $3.3 billion over 5 or 6 years gives us plenty of opportunities. The retail opportunities are mainly around extending existing centres. We've just embarked on one in Melbourne, High Point, which is a $300 million extension. But we'll also look for opportunities for office construction where we can get a significant pre-commitment. We've got something approved in Lonsdale Street in Melbourne. We're just searching the market now for the right level of tenant and rent. Once we've achieved that, we'll be in a good position to move forward.
Thanks for joining us, Michael Cameron.
Thanks, Alan. Great to be on the program.